Have you ever felt your heart sink watching your savings vanish overnight? Imagine waking up to headlines declaring the stock market has plunged faster than anyone predicted, and the familiar numbers on your Robinhood or Fidelity account feel like a blur of red. The fear, the confusion, the questions swirling in your mind. Did I do something wrong? Will I ever recover? This is the reality millions of Americans faced during the stock market crash of 2026. Welcome to Crypto Brain Power, a channel dedicated to helping beginners navigate the complex world of investing with clarity, patience, and understanding. Before we dive deeper, I want to hear from you. Comment below on what stock market topic you'd like us to explore next. Your thoughts could shape our next video. Subscribe to support the channel and continue learning with us. The crash didn't happen overnight. It was the result of months of tension in the U.S. economy. Federal Reserve meetings, raising interest rates to curb inflation, created ripples through the market. The consumer price index had been climbing steadily, making everyday goods more expensive, and job reports showed unexpected shifts in employment trends. Investors began to panic, questioning the stability of giants like Apple, Tesla, and Amazon. Many beginners had poured their savings into the market through apps like Robinhood, while more seasoned investors relied on platforms such as Fidelity or Charles Schwab. Regardless of experience, the sudden drop was shocking. The S&P 500, long seen as a benchmark for stability, lost a significant portion of its value in just weeks. But amid the panic, stories of learning and resilience emerged. One young investor, who had recently started investing in tech stocks, realized the value of diversification. Another, who had kept emotions at bay, used the crash as an opportunity to understand market cycles rather than chasing quick gains. To truly understand why the crash happened, it helps to look at the chain reaction. Higher interest rates made borrowing more expensive for companies, slowing growth. Consumer spending slowed as inflation ate into wages. Investors anticipated slower profits and began selling stocks, triggering further declines. In moments like these, the market can feel overwhelming, almost personal, but it's a reflection of broader economic forces, not individual failure. Learning from 2026 means embracing uncertainty, not fearing it. The crash reminded investors that discipline and patience are far more powerful than timing the market perfectly. Those who stayed calm, avoided panic selling, and revisited their long-term strategy often recovered faster than those who reacted impulsively. Real-life examples make this clear. Apple's stock, after a sharp drop, slowly regained momentum as the company continued innovating. Tesla faced production challenges but adapted to the changing economy. Amazon, despite temporary setbacks, leveraged its diverse revenue streams to weather the storm. Watching these companies recover teaches a vital lesson. Resilience is built over years, not days. Platforms like Robinhood, Fidelity, and Charles Schwab played a key role during this period. They provided tools for beginners to track performance, set alerts, and stay informed on economic events, from Federal Reserve announcements to jobs reports. These tools remind us that knowledge, paired with patience, can reduce fear and improve decision-making. By the end of this turbulent year, many investors discovered a new sense of calm. The initial shock faded, replaced by a deeper understanding of risk, long-term thinking, and the value of staying educated. The stock market crash of 2026 was more than a financial event. It was a lesson in human psychology, discipline, and resilience. This video is only for educational purpose, not financial advice.